Today we're talking about dividend investing so that we can generate that sweet passive income. Hello and welcome to our modern money journey. Just a brief reminder that I am not a licensed professional. This is not investment advice. This is for entertainment purposes only. Hi, I'm Joe with Our Modern Money Journey. If you're new to the channel, please make sure to hit that subscribe button. And everybody, please make sure to hit that like button. This really helps out the channel. The YouTube algorithm appreciates it, and so do we. Thank you. So the whole point of dividend investing is to generate cash flow by investing in companies that pay dividend to its shareholders. So what is a dividend? A dividend is a portion of a company's earnings that is paid to its shareholders. This is typically a very small amount. So in percentage terms, it's typically 1, 2, 3, 4% annually. So 4% would mean that if you invest $100, you would receive $4 every year in dividends. This is typically paid out quarterly. So in that example, the $4 would be broken up into $1 every 3 months that you would receive. This is just an example. Dividend yields can range all over the place, but are typically on the low end of a few percent. So I know putting in $100 and just receiving $1 every couple months or a few pennies every couple months may not seem like a great deal. But if you reinvest that dividends and continue to put in more money whenever you have free capital, this will grow over time, and then the money that you're receiving in the form of dividends from dividend payments from your companies will be quite substantial. I personally don't have too much money in dividend positions, but just the other night I was tutoring my neighbor in some linear algebra, and then I got a notification on my phone which said that I had received $2.70 in dividends from one of the companies that I own. I then realized that we're entering dividend season, so I opened up my account and saw that over the next couple days I'd have about $40 to $50 in dividends coming in. This felt great as I was making money by helping out a friend and making money by just sitting there and collecting my dividends. Kind of a double dipping situation, if you will. I know $40 or $50 is not that much money, but I get to take that, reinvest it, and then next quarter when it's dividend season, I'll get paid even more. This is what's great about dividend investing. It just grows, and then you get paid more and more and more over time as you reinvest it. And all because you're a partial owner of a company that pays dividend. But lots of companies pay dividend. So to help you out, we'll talk about 3 metrics that you can utilize to help you evaluate dividend paying companies and see whether they're a good purchase or not. After that, I'll tell you what my top 3 dividend positions are. So in addition to the dividend paid, which is the dollar amount received per share, or the dividend yield, which is that dollar amount received divided by the current share price, so it's expressed as a percentage. So in addition to those, the dividend yield or the dividend, there are 3 other metrics that you can look at to get a quick idea of how well a dividend company is doing. The first of those metrics is the payout ratio. This is the percentage of a company's earnings paid out as dividend. So for example, if a company has a payout ratio of 50%, that means they're taking 50% of what the company is earning and paying that to shareholders as dividend. If the payout ratio is 100%, that means it's taking all of their earnings and paying it to shareholders. So you actually want this payout ratio to be pretty low. If the payout ratio is high, that means that the company is overextending itself. It doesn't have enough earnings to grow, or it's paying out all of its money as dividends and not saving any so that the company can grow. This is very unhealthy. So just remember, the lower a payout ratio, the better. Since dividend companies are typically well-established companies, we can also look at the price to earnings ratio. This is the price of the company divided by the earnings of the company. So with the price to earnings ratio, the lower, the better. If it's low, that means that the price is low in comparison to the earnings. Or another way to state that is the earnings are high in comparison to the price. So that's attractive to us. We want that. Clearly, we don't want to be paying a high price for something that isn't earning a lot of money. So we want the PE ratio, or the price to earnings ratio, to be low. What we use the PE ratio to do is to evaluate a company against its peers. So we look at the PE ratio of several companies that all function or do the same thing, or are all in the same industry. The PE ratio is a good tool for comparing companies in the same industry or in the same field. It's not really meant to be a standalone metric. But just remember, the lower, the better. Lastly, we want to talk about the earnings per share growth rate. So the earnings per share growth rate is simply a measure of the growth rate of a company's earnings. So it's telling you if it's positive, the company's earnings are increasing year over year, and if it's negative, the company's earnings are decreasing year over year. So clearly we want this to be positive, and the bigger, the better. Looking at these three metrics along with the dividend or dividend yield can give you a quick idea of whether a company isn't worth buying or whether you should do more research to look at it in more depth. But now let's talk about my top 3 dividend positions that I hold right now. So number 3 is General Dynamics, ticker symbol GD. General Dynamics is an American aerospace and defense corporation with a healthy 3% dividend. Moving on to number 2, it's Medical Properties Trust, ticker symbol MPW. Medical Properties Trust is actually a real estate investment trust, meaning that they own property. They own a lot of different hospitals and like rehabilitation facilities. And I'm always a fan of investing in the medical field, especially when it pays a 5.8 dividend yield. So moving on to position number 1, it should be no surprise to anyone, it's AT&T, ticker symbol T. With a 7.4% dividend yield, there's not too much to complain about with AT&T. Yes, their stock price has been stagnant for a while, it's even been coming down over the last couple months. I simply see this as a buying opportunity. I also just like having that cash flow come in every quarter. That 7.4% is great, their payout ratio isn't overextended, and it's AT&T. They're not going anywhere. They're going to be around for a long time, and they're going to keep paying that dividend for a long time as they have in the past. But just as a reminder, these are my top 3 positions. You need to do you. Alright, all you bulls and bears, I'll see you next time.